Welcome to the Lend Academy podcast, episode number 216. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register. Today on the show, we are heading down under to Auckland, New Zealand, in fact. And I'm delighted to welcome Harmoney. In fact, we have two gentlemen on the show today. We have one of the co-founders, Neil Roberts, who is the outgoing CEO. And we also have David Stevens, who is the incoming CEO. By the time you listen to this, he will be in the job. And wanted to get them both on the show. Obviously, Neil has the background and history with Harmoney. We talk quite a bit about that. We talk about the loans themselves and what sort of the segment of the market they're going after. We also talk about the banking environment in Australia and New Zealand. It's very different to the United States, and David has a lot of history there. And we talk about the fact that they've been able to scale pretty significantly, over $1 billion, $1.2 billion in a market that's about 1/80th the size of the US. So that gives you some sense. And we talk about how they've been able to do that and what the future holds, and possible expansion, or they're already in Australia, but really building up their Australian presence. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Neil and David.
Thank you, Peter. Thanks, Peter.
Okay, so great to have you guys on, and always good to be speaking with someone from down under. But before we get started, why don't you give the listeners, both of you, maybe we'll start with you, Neil, give the listeners a little bit of background about yourselves, particularly with what you did before Harmoney.
Sure. I think there's obviously well into my career now, so I'll maybe just pick out the two relevant projects. So in 2001, I saw an opportunity with a consumer finance company to build some tech to automate the credit and to build a business with direct mail. We did that, started it in 2001, did 3.6 billion in personal loan applications, and over the next 5 years, wrote about 1.6 billion of that, and finally sold the business in 2006 to GE Money. So it was myself and the sort of Harmoney core team. Some of us then went over to Australia from New Zealand, and that's where I met Dave, and we helped Flexi Rent float, became Flexi Group. And then after that sort of 10-year stint, decided to come back to New Zealand and just saw an opportunity to start Harmoney, because the law was changing, and I'm sure I'll get an opportunity to talk about Harmoney in a moment.
Mm-hmm. Okay. Yeah, over to you, David.
Yeah, thanks, Peter. Look, in terms of my background, I was originally PricewaterhouseCoopers, ended up working on the float of Flexi Group, and got to know Neil and Brad and the team then. Had a number of different roles there. Really grew the business up from a one product, one channel business to a diversified financial services business. Had a number of different roles, being Group CFO in 2013, through to being Group CEO for about 12 months before taking on the Managing Director role of Flexi Group New Zealand, which represented about half of the business. And since then, I've went into a startup business called My Fund, which recently sold a 35% equity interest to the Bank of Queensland. And I've been excited by the opportunity, what Neil's been doing in the Harmoney business, and obviously it's just come across last week into Harmoney.
So are you living in New Zealand or living in Australia before this?
I've been living in Australia most of my life, but I commuted when I was Managing Director of Flexi Group New Zealand. I sort of came over every second week for about 18 months. Right,
okay. Are you going to stay in Sydney, or are you going to head to Auckland?
I've got a new baby due in about 6 weeks' time.
Okay.
So I'll be in Australia, be commuting for a little while, but The intention is to look to move over to New Zealand sometime next year.
Right. Okay. So then back to you, Neil. I want to get sort of into the sort of, the founding of Harmoney, and what was it you saw in the New Zealand market, and what was the impetus behind the founding of it?
Yeah, sure, Peter. So I think first and foremost, there was a law change. So prior to that law change, you wouldn't have been able to contemplate doing peer-to-peer lending, and that was because of the securities law and the fact that every borrower would have to, issue a prospectus. So the law change came. It was just following the back of tail end, I suppose, of the financial crisis, and the legislation itself was sort of once in a lifetime review of the fundamental financial services regulations. So great opportunity, and of course, we had a team that had done it before. We had a team that had raised money on the one side through a call centre and automated the process for that call centre, and obviously 1.6 billion in written personal loan deals on the other. So with those two things coming together, another reason for the move by the government, because we are, I think, still the only country in the world that offers a peer-to-peer lending licence. And part of the reason that the government were bold enough to do that was because New Zealand has struggled with a couple of key things over the last 20, 30 years. One is productivity, and the other is savings. And we were inspired, I suppose, to help to a startup, join the tech community, and try and solve for both of those things. So using tech, which would ultimately help your productivity and offering risk-weighted returns and a new asset class to the retail public. So, and also, putting the team back together was fun too, and getting back to what we knew, I suppose. Yeah,
right.
That was the thinking behind it, Peter.
Okay. So maybe just briefly give us some of the milestones. I know it's been, I think you were saying it's been 5 years this month since you started. So tell us sort of how things have evolved and maybe some highlights over the last 5 years.
Yeah, sure. I think one of the key highlights for me has been the team and how we've performed when we were just 6 people, getting the startup up and running and getting to market. We set ourselves some goals, and we were, I think, the very first platform to get $100 million to lend before we sold our first loan, and we did that off the back of our ability to underwrite risk. And Peter, I think we actually met around that time, because coming to lend it was absolutely a pivotal time for us, because we met some great contacts, and it helped us down the track getting some funding. So putting the team together, getting to the point where we had the algorithm was right, the system was right, and we were able to attract wholesale funding, meant that we could change a two-sided marketplace to a one. In other words, we could wait for retail to come on board, and of course, having the endorsement of some wholesale providers, helped bringing retail on, and therefore we grew rapidly. I think the second thing would be how New Zealanders have embraced the platform. We have 500,000 people that have joined the platform. We've done 1.2 billion in lending in that 5-year period here in New Zealand, a country of 4.5 million people. So New Zealanders truly have embraced it. And I think getting to a point where we in-housed our technical resource, that today Harmoney's pulse is very much with its engineering team, and we do see the future in our platform and automation. So getting our platform in order, getting a team together that was norming and storming. And I think that some of the challenges that we've had, I suppose, is an unclear, and we didn't know this until after we launched, just an unclear set of laws that don't perhaps work well together. And that's meant that since 2015 we've been slowly operating a pivot and moving to lending our own money, which we started to do December last year, and we're rapidly picking that side of our business up, because the regulations, particularly in New Zealand, are such that we don't see a viable model for us doing peer-to-peer lending way into the future, and we are sort of managing that and have been for some time. We made a decent amount of profit last year and good revenue growth as well, so quite pleased about that. we measure and take very seriously our engagement here as a team, and we have benchmark scores at employer of choice level. And then finally, our net promoter score from our borrowers in particular is extremely high. I mean, it's higher than some of the names that you think of in that ilk. Amazon, Netflix, Apple, we tend to score higher than that. So all in all, a business that is maturing and ready to grow, and embraced by a lot of New Zealanders and by our licensor, I think, the Financial Markets Authority. Yeah, so those would be some of the highlights.
Okay.
It's been a great journey.
Okay, well, we'll dig into some more of that in a little bit, but I want to turn to David and just sort of maybe you'll start with, when did this sort of get on your radar? When did peer-to-peer lending, marketplace lending get on your radar first?
Yeah, look, probably, round about the same time that Harmoney started, maybe a little bit before, obviously seeing the businesses out of the US. Obviously the natural sort of point where you had investors looking for yield and you had borrowers looking for, a fair price loan. I guess it obviously, when you simplify it like that, it makes a lot of sense. And I guess having worked in consumer finance for the last 12 years or so, I really recognised that there was a lot of lenders out there that were very much one-size-fits-all approach. So particularly the banks where, there was no rate for risk. It was very much, you either get approved or declined. And this is both in the traditional finance businesses as well, where, you tend to get a very similar customer demographic when you're operating like that. With obviously when you're only using one rate, whereas with one of the things that impressed me about the Harmoney business was the way it's able to grade risk in 30 different risk grades, and allow a customer who is a higher credit quality to borrow at a lower rate, and they're a customer that maybe slightly lower credit quality is they still able to borrow at a rate that's appropriate. So I think that was something that I didn't see being done very well, particularly in Australia and New Zealand, and something that really sort of made that the marketplace lending get on the radar. And I think that's why you see more businesses today adopt that sort of risk-based pricing methodology, and something that I think is the way forward.
Right. Yep. Fair enough. So Neil, I want to turn back to you and just, we're actually recording this during this transition. You've been, founder, CEO, co-CEO, and now you're stepping back. So what was the reason to bring on someone like David as CEO at this stage of Harmoney's development?
Yes, so the first thought, or what I've always thought, is a lot of founders flounder when you get to the public markets, and in this part of the world, the deep pockets of capital are in the public markets, and as you know, Peter, companies tend to go a little sooner to those markets for that reason, and the ASX is trying to attract those that perhaps don't have the market cap to go on the Nasdaq. The compulsory super in Australia is, I think, $2 trillion or something like that, some crazy number like that now. So it's a huge source of capital to access. So for me, I always felt that that I wouldn't want to be a public-facing or public markets-facing CEO. For two good reasons. I don't think I'd be very good at it, and I don't think I'd enjoy it. Now, the team here has worked with David before. I think it's a 9-year sort of interview process both ways, and really enjoyed that. We enjoyed some great success at Flexi, and that was during some tough economic times. And it's great to see that Dave left Flexi and almost as a favour took on what would have been a failing startup, because unfortunately the founder of that startup had passed away, and turned that around as well. So obviously proving in the process that good at the big top end of town and good also with the startup. So knowing David well, knowing his skill set is absolutely bang on for what we've got going forward, and having been on this journey myself for 7 years, I just felt it was time that for everybody's sake that we got a new CEO on board, and from here hopefully can get back to doing the things that I really love, and that's just starting new parts of businesses or creating value in some way, rather than what becomes quite a large beast to manage.
Right. Okay, fair enough. So David, I want to turn back to you and just give a little bit of a sense, because a lot of people are obviously going to be not very familiar with the Australia and New Zealand market. So maybe you just give us a little sense on what the banking climate is like down there, and in particular, sort of the personal loan market as well.
Yeah, sure. Look, Australia is a little bit unique, and I guess New Zealand as well, in terms of the banks dominate sort of around 80% of the consumer finance market. We've got big four banks that are very strong, and went through the global financial crisis relatively unscathed. Didn't require any sort of government bailouts and the like, and they've really, I guess when you dominate a market so much for so long, you become quite complacent. And there, in the outside of that, you've got point of sale finance companies as well. There's been a lot of companies come into the space. There's a lot of startups and the like that have come into the personal loan market, particularly in Australia over the last few years, on the back of Australia just had a royal commission into the financial services sector.
Yep.
And that has actually created extra, I guess, regulation and challenges for the banks, particularly around some of some of the profitable areas that they're now looking to divest, and that's well seen because it's due to conflict of interest and the likes with those sort of advisory businesses that sit with the banks. Fortunately, they all escape with legacy systems as well, and processes as well that makes it quite hard for them to adapt to the type of lending that consumers expect these days. They want to have, I think people have less patience now than what they may have had a few years ago, and you sort of want to be able to give a couple of pieces of information to a financier, and then we go off and make our credit assessment, and we're doing all this in real time. So I think that's where the fintechs, if you like, in Australia and New Zealand are really sort of cashing in. And when you've got sort of four beasts that have 80% of the market, you're able to chip away at that and get some good volume from that. The market overall has been fairly benign in terms of growth of the market, but certainly the share of the non-bank lenders is certainly growing quite rapidly, both in Australia and New Zealand. And if you look at the success that Harmoney's been able to achieve, around 1.2 billion in new loans written in New Zealand, you can see the opportunity in Australia, which is a population of around 6 or 7 times the size.
Right. So I just want to go back, and the readers probably don't know what a royal commission is. Most of them, or the listeners, probably would need a little explanation. But I follow that to some extent, and the banks have been really. I mean, what I'm curious about, maybe just 30 seconds on what the Royal Commission was all about, but then how has that sort of impacted you guys? And I imagine it's a positive because the banks have come out of this, with their brands tarnished. Does that mean that it's really some tailwinds for you guys?
Yeah, look, I think so. Just for the listeners, a Royal Commission is basically I think in simple terms, a government deep dive or investigation into all practices that go on in that particular industry. They're doing another one into, I think, into healthcare coming up. I'm not sure the exact schedule, but it's basically going into a deep dive where banks have to, in this case, have to present, all their dirty laundry, in those terms, and they then are assessed on various things. And there were quite a number of areas where not just the big four banks, actually, some other providers like AMP and the like were basically some practices were called out that were not what you'd expect. And as a result of that, the regulator and generally the public, the public as well, have obviously been quite sort of shocked by some of the details that have come out of that. So I think to your point, Peter, yeah, look, there's certainly, a bad taste left in some people's mouths around that. And I think that does create some opportunity for us. And I think you can see in Australia, the personal lending as well as the SME financing as really sort of, it was already taking off, to be fair, prior to the Royal Commission, but that has added some fuel to the consumer and SME finance businesses, both in Australia and in New Zealand. Pretty much the big four banks in Australia are the same in New Zealand, just may have different names, that they're all owned by the same group.
Right. Okay. So we should just dig into the actual products themselves for a little bit. Tell us about what are the range of interest rates, the loan sizes, loan terms, that sort of thing.
Yeah, maybe I can do that, Peter. So in terms of terms, we offer a 3 and a 5 year loan simply, but absolutely no penalty for paying back early. And therefore, we tend to get an average term of weighted average of about 58 months. In terms of the interest charges, keep in mind that we operate in a market where your higher FICO type credit is paying 19-20% on their credit card. Mm-hmm. So we start at 6.99. So we can do $70,000 for an A grade, and we can do that in sort of turn that around in 10-15 minutes, and at a rate of 6.99, which is a champion rate, all the way through to, in New Zealand, 29.99, and it's 6.99 to 24.99, I think, in Aussie, or there or thereabouts. So now we do very little of our business at the extremes. So at 29.99, we might do by dollar 3 or 4%, but it's a far bigger number by number of loans. And we find that if we weren't to help at that sort of pricing, perhaps there are other lenders out there that are far more expensive. So we really, the science behind it is we took a credit card rate at the time. We did a spectrum or a universe of credits, and we made that the weighted average, and pushed out a typical bell curve across across that spectrum. So we're doing most of the business in the low B grade, C, and high D grade. Yeah.
And so, what's the average loan size then?
Average loan size today is about 26,000 Kiwi dollars.
So what? So 26. What's the exchange rate these days with the US?
US is doing pretty good at the moment. I think it's about 65-70%, isn't it?
Okay.
Yeah. Is that right, Dave?
65,
yeah.
Right. Okay. So you take a top 35% off that for the US equivalent. Okay. Then, so what about the underwriting? I'm curious. I'd like to sort of just dig into that a little bit and get into how you're using technology, how fast this all is, and what are some of the data sources, that sort of thing. How are you doing the underwriting?
Yeah, thank you for that. So we obviously credit. We pride ourselves on doing credit first and well. And obviously, I mentioned before the fact that we had that 100 million to lend before we sold us the personal loan, and that wasn't without some deep DD and rigor. So we had scorecard 1.0. 1.0 was a demographic scorecard. It wasn't really using our own data because we didn't have any. We just started. We've since launched 1.5. We're ready to go with 2. 1.5 set us up for really cutting back on the data points that we need to ask the customer for, the borrower for. Because what we've built in our platform is the ability to have an instant and two-way conversation where we can highlight data to a potential borrower in a format, having gone and got it externally, and have that borrower just confirm, and if it's wrong, obviously just make the amendments. So 1.5 set us up for that, and it's really helped our conversion through the funnel. The next edition, which we're about to do now, really does cut back on data points. Peter, you may not know this, but this month is a big month in Australia because positive reporting comes in for the very first time with plenty of coverage from the banks. So it's been on the horizon for a while. The banks have kind of missed the dates a couple of times, I think, but now we're finally there, which is, it's not quite a FICO score. It's certainly we don't have the ability to get the sort of data you can get in the States, but this is really a big step in that direction, which will really, help, the likes of Harmoney underwrite. But what do we do from a technology point of view? I mentioned the platform and the two-way conversation that we're able to have. So the headwinds from the regulator is they do want you to check in with customers, and we know ourselves that it's a lot better to go and get external data and actually be able to present that. So we have, over the last few years, been automating the lending decision more and more and more. It is an immediate payback. If we're able to automate more of a percentage of what's coming through our funnel, the conversion goes up exponentially because people enjoy the experience. The reason we're on that track is because we obviously see voice and digital assistance in the not-too-distant future is dominating our space. So, you can't have a voice interaction where you're asking lots of questions back and forth because that's a telephone conversation. So you really have to double down and invest in your ability to have straight-through processing and automation. So we're on a journey to 80% straight-through processing. We're about 60 now, and in that 60, it's untouched by human eye and it's instant decisions. And over the next year, we'll start lifting that percentage exponentially.
That's really interesting. Super interesting, actually, because I think that it's challenging to be able to do that, the straight through kind of automated underwriting. And there's several companies in the US that have tried. None of them have made it to 100% at least on the consumer side. But it's certainly a goal of many of the companies here. So I want to switch gears a little bit and talk about funding. I know that you said you had the 100 million before you got going, which was very impressive. I don't know any platform that anywhere that launched with that kind of war chest. And I know that you've also had some investment. You've had some good relationships with several US investors. So maybe tell us about the funding side of the business, where the capital is coming from.
Yeah, sure. So I think I mentioned a little earlier that we launched and we have since had reason to question the regulatory environment in which we operate, and that has led us to a move to simplify our funding model. We operated as a peer-to-peer lender. We're licensed as a peer-to-peer lender with 18,000 lenders operating on our platform. The regulatory environment we just see threatens that business model just because of Harmoney's ability to earn. So where we see more of our future is going on balance sheet. We started that journey in December, and Dave, as CEO, has a very good pedigree when it comes to his contacts and his ability in the capital markets here, given the balance sheet that he ran in Flexi Group. I don't know if you want to comment on that, Dave.
Yeah, no, obviously being able to diversify our funding sources, so there's obviously an element of the peer-to-peer, but also being able to get wholesale funding warehouses and then lead to securitization of the receivables allows us to really optimize the best cost of funds, and also provides us with the availability of funds at all different levels on the risk grade by having the bank warehouses in place. So we launched our first bank warehouse in December last year, and in New Zealand we're looking to roll out another one in New Zealand with another bank, and then also a couple in Australia as well in the coming months. So that'll give us some really good diversity of funding, and also allow us to sort of maximise the returns.
Right. So are you going to eventually shut down the peer-to-peer side of the business?
No, look, I think we're sort of, as I said, we're looking for the diversity of the business in funding at this point in time, and we'll obviously look to over time we'll continue to assess that, and but certainly we've got a lot of lenders on the books at the moment, and does create that diversity for us, which is which is a good position to be in.
Right. Okay. So you did mention this earlier, but I want to just zero in on it. I mean, this is obviously you're a New Zealand company. New Zealand is a small country. It's quite impressive because it's like, I think it's like 1/80th the size of the US or something like that, and you've done over $1 billion. So that would put you up over Lending Club if you extrapolate that out over here. But curious about, the Australian market is you said like 6-7 times the size, and I think I read somewhere you passed 100 million in Australia, and so obviously the vast majority of what you've done has been in New Zealand. But with Australia being the bigger market, are we going to see a big push into that market coming up here soon?
Yeah, no, we certainly are. Obviously the business has been run out of New Zealand. It will continue to be run out of New Zealand. It's one thing that attracted me to the business. It's a highly scalable business due to the fact that Neil spoke about the straight-through processing and various things like that in the platform. But yeah, look, Australia is certainly going to be the key focus of the business. Obviously, me having the Australian accent as well in the room, obviously got a passion about that and quite familiar with the market over there. So we've written, as you correctly said, we've written over 100 million in Australia now, which is always your hardest 100 million to write. It costs you the most. You learn from a losses perspective, and you're obviously building up the channel and building up brand as well. So I think the business has done fantastic to write that sort of number. We've really without a focus, and I think it shows the power of the platform and some of the relationships we have over here to be able to move that across into Australia. And yeah, look, I'm very excited and very, very keen to really get the Australia push, particularly but towards the end of this year. As we sort of get some of the funding lines sorted out as well, that will help that move as well.
Right. We're almost out of time. Before I let you go, maybe Neil, over to you just first. What are you going to do now? I mean, you're stepping back from the day-to-day role. I mean, I presume you're going to stay, involved at the board level or something. What are your plans?
Oh, look, I remain the largest shareholder in Harmoney, and between myself and the founding team, we still own over 50%. So my interest is in supporting David, obviously, and making sure that I help wherever I can in terms of the next phase of Harmoney's growth. What I would love to do, Peter, is get involved in some of the opportunities that are coming up. We have great momentum around open banking data, around CCR coming out, around the willingness, particularly in Australia, of the population to actually want to take a positive move away from the big banks, given the recent publicity. And I'd just like to get back to creating real momentum and wealth, taking on a big opportunity and delivering on it. So we've got a few ideas, but what I'm going to do first up is when the baton officially goes over to Dave in a few weeks' time, then I'm going to take a holiday and get out of his hair for a little while and enjoy some summer and, come back fit and ready to take on the world in the early new year.
Okay. Well, enjoy that. And so, and David, what about you? What's, your own, I know you really haven't officially even begun in this role yet, but what are sort of your priorities for the next 12 months?
Yeah, look, it's a good question. Look, the good thing about the business, it's performing really well. So it's not like if it's not broke, you don't need to fix it. And but the key focus will be really leveraging the platform to grow out Australia, continuing the growth in NZ, and building up some of those funding warehouses that we spoke about, and looking down the track to set them up so we're able to securitise those customer receivables, to ultimately optimise our cost of funds in the business. So that'll be the things Neil mentioned. Continually innovate. We've got a team in IT engineering of around 50 people, and that's really where the key to the business is, and how we stay ahead of competition and make the customer experience better. And that's something that we continually do. It's not we don't create a process and then forget about it. It's about how do we make that customer experience better every week. So we're at the keeping those NPS scores up and the like that Neil spoke about. So that's something that's we almost count as hygiene in the business rather than projects where projects start and stop. It's something that's continual learning for us.
Right. Okay, well, we'll have to leave it there. Thank you, Neil. Thank you, David. I really appreciate you both coming on the show today.
Thanks, Peter. Thanks, Peter.
Okay, see ya. I'm always impressed when I talk to companies in these smaller markets. It's not easy to scale to get to, $1 billion, or it's not easy, not to mention it's not easy in large markets either, but it's much, much more difficult in smaller markets to really get to significant scale. And that's what Harmoney's been able to do. And, they really have barely scratched the surface of the Australian market. And that is obviously has tremendous potential for them as well. And I think, given their track record of success in New Zealand and the fact they actually have an Australian CEO now, I'd be very surprised if they don't make really significant inroads into that market in the near future. Anyway, on that note, I will sign off. But before I do, just a note, we'll be in Lend It Europe next week, Lend It Fintech Europe 2019 in London. So there'll be no podcast episode next week. We'll be back in 2 weeks. So thank you very much for listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register.